to secure attractive returns for our investors. And we also focus on how flexible and adaptive the platform is so that we can execute either investment deals, or we can focus with and work with specific managers we'd like to, or we can deploy faster. And deployment is one of the key criteria for investors looking to execute their private debt strategy in the current market. Apart from structural alpha, there are some managers that we see that either have proprietary, very strong flow of deals, and this is something that we focus on during our due diligence as much as our London colleagues in Orla's team. And some of the other aspects, for example, if the manager is using a new technology and in underwriting or origination process, this is something that we would identify as well.
Maybe we'll continue on that theme. One of the things that you'll read in the Financial Times or the Wall Street Journal is the supply of capital into this space. Now, I'd like to ask you both, maybe starting with you, Orla, how has that impacted those returns in Europe? And how has it impacted the manager universe, both the size of the universe and the number of players raising?
So I think because of the market in Europe opening up, because of it being particularly attractive on a risk-adjusted basis when you compare it to the syndicated loan product, there has been a plethora of managers raising capital. I think that's partially offset by the fact that the market is just opening up. We did see a lot of bank retrenchment. You'll have seen from the previous slides the level of bank disintermediation, which I think accelerated quicker in Europe, as we were saying in the panel earlier, because it was in fact already a little bit behind that of the US, and changes in regulation, etc., that managed to accelerate that process. So you have had this huge build up of dry powder, deployment pressure, but at the same time it being partially offset by a market that has opened up. There is demand for it. At the same time, I would say over the last 12 to 18 months, pricing compression, nothing to do with base rates. We're still unfortunately at negative in Europe, but capped at a floor of 0. But there's been pricing compression on the margin. So we're talking maybe 60 bips, 70 bips. What you've got to watch out for, and this is a little bit more nuanced, is, listening to deal flow, listening to the whispers on the street, asking yourself who is doing these deals where other managers are not doing them. And I suppose because of our proximity to the managers in Europe, who are predominantly based in London and 1 square mile, we do have a good understanding of who those managers are. We can see the number of deals that have been rejected effectively on structure, on pricing by certain managers, and where other managers have decided to go ahead even with, one covenant at 50% headroom and pricing at 5% or something. So look, those are the things that we need to be mindful of and we need to be wary of.
And Olga, one of the characteristics of the US market, I guess, that we like at Stepstone, because we really value the deployment capability of markets, that capacity planning, is potentially that deeper market. Is that?
That's right. I was going to say that the upside for you, Orla, is to kind of have already access to the managers in Europe, because there is perhaps fewer, not that many as in US. And US is has a much longer track record and established history and has been around. And the banks, as we've seen in the first slide, are, well, by large, we're retrieving from the market. So this is, US is in a different space when it comes to private debt. So deployment capacity is not normally an issue. But there is some pricing challenges, and there's been very tight spreads, reflecting how much capital has been raised. One point though, I was just gonna add, I think when we talk about capacity, we focus on the supply and how much capital is being raised and what private debts are doing and how many private debts are coming to the market every single year. I think the other side of it is the demand. And when you look at the middle market in the US, it's a vast vast majority of companies that are either family owned or founder owned, and
which is the core which we would expect to see through a credit correction. It sounds like there are areas where we see perhaps dislocation and mispriced risk, which we seek to harvest in the middle of that credit cycle.
That's a good summary to my ramblings.
And then, well, finally, and also with your NPL point in mind, and maybe, Olga, you can expand on it, but we see this opportunistic capability. And I suppose one of the key messages that we have in private debt is that we should have this core, continual, very efficient allocation to performing private debt, and then reserving some capital for that cyclical approach. Is that correct? And what other strategies could we add to the NPL opportunity, corporate credit, as we move into a correction?
You're absolutely right. I think core, and we sort of to classify our world and the managers, which the universe of them is quite large. What we do, we focus on the core that have very well-defined strategies, and it's almost like they work like banks. They underwrite, it's almost like a factory, an underwriting factory. And there we mainly focus on how boring, stable, and sort of this question of good, ideal partnership we can form with them, right? Because we would be looking for using some of the deal flow and forming partnership and investing in their products and advising our clients accordingly. The other set of direct lending and private debt strategies is to do with opportunistic credit. And there, the idea is that there are some managers that are, well, capable and can underwrite in distressed times, and therefore allocating to those managers makes sense. And having maybe either within the broad strategies or multi-strategy portfolio some allocation to the times when the syndicated market is not performing and there's no liquidity, then there's going to be some opportunities like that which they will take advantage of. And just looking at this particular slide, it's more three-dimensional because it takes duration into picture. And I think this is something to do with also our discussion with our investors and clients, because what they have on the liability side defines what kind of opportunities we bring to their attention. And that forms a dialogue. So let's say on infrastructure debt, that could be absolutely perfect for a life insurance company, but that wouldn't fit an endowment or a family office portfolio. And just to add to that, some of those strategies are quite niche, but growing fast. Like let's take marketplace lending, for example, which is capital provided to potential opportunities that are originated via online and tech platforms. And it's quite a small market at the moment in US, but it's growing.
I think that's actually a good point, Olga. Marketplace lending, it's something that is growing in institutionality, I would say. I think the platforms are incredibly sophisticated. We've done a significant amount of not just the usual, call it strategy diligence, but operational due diligence. I think it's incredibly important for this marketplace lending just because of how they effectively underwrite. The key issue that we would have with them at this stage is obviously little bit unproven, but more than that, it's that the behavioral maturities of the underlying loans are incredibly short.
Yeah.
Sometimes inside of 12 months. So it's difficult to stay invested, I would say. And on that basis, what you do have is you have your actual cash on cash returns effectively impacted. The other point, and again, this is to what you were saying, Olga, but it's the availability or capacity of this strategy and scale is just not there yet.
Yeah.
I think, I'm sure people have heard of Funding Circle, maybe. It's I would say the leading marketplace lender provider in the UK and across Europe. They recently actually floated. The issue that they've been facing is that I think the average loan size is somewhere in the 70K region for SME businesses. There's a high propensity to get that repaid. Oftentimes there's personal guarantees against these, sometimes personal homes, mortgages, that type of thing. So yeah, scale.
But it's not a scale opportunity, I suppose, with the capacity demands that we're seeing amongst our client base.